Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Dave Briggs. Well, today is International Women's Day, and we are celebrating the day by featuring women guests across all sectors, CEOs, activists, politicians, and economists. Our goal at Yahoo Finance every day is to bring you diverse voices that reflect our diverse society and to normalize seeing smart people of all stripes talking about business and finance. But we want to get you up to speed on the market action as we kick off the final hour of trading. The Dow and S&P headed lower. Looking at the Dow, off another 166 points today. The Nasdaq barely holding on to gains on the moves coming as investors weigh Fed Chair Jay Powell's hawkish comments. Now, Powell spent a second day on Capitol Hill today. This time, he was questioned by the House Financial Services Committee. We will have the highlights in just a moment.
Then we'll speak to WNBA Commissioner Kathy Engelberg. We'll ask her about the WNBA's growth and team valuations as more and more investors look to the sports space. But first, let's get you up to speed on what Fed Chairman Jerome Powell told the House Financial Services Committee today. Jen Schomburger is here with the details. Jen, good to see you. What do we hear?
Good afternoon, Dave. Fed Chair Powell wrapping up his semi-annual testimony to Congress today before the House Financial Services. Fed Chair Powell keeping his options open for how much higher the central bank could raise interest rates at the next policy meeting after opening the door to a potential 50 basis point rate hike on Tuesday. Powell pointed to the upcoming employment report Friday, along with key inflation reports next week with PPI and CPI reserving judgment. Take a listen.
When we say that we're going to be looking at the totality of the data, which is what I said, that does include these reports yet to come. They're going to be important in our assessment of the higher readings that we have very recently received and of the overall direction of the economy and of our progress in bringing inflation down. And we'll be carefully analyzing them. Again, we have not made any decision about the March meeting. We're not going to do that until we see the additional data. The larger point, though, is that we're not on a preset path.
Powell reiterated to the committee that inflation is running higher than expected and that interest rates will likely need to be raised higher than previously thought. Though Powell avoided telling lawmakers just how much higher the central bank could raise rates, only noting that Fed officials will release new forecasts at the March 22nd meeting, but that rates would likely need to rise higher than the range of 5 to 5.5% projected in December. Now, Democratic ranking member Maxine Waters chided Republicans on the debt ceiling and asked Chair Powell about failure to raise the debt ceiling. Powell warned that the Fed cannot protect the economy from default.
No one should assume that the Fed can protect the economy from the non-payment of the government's bills, let alone a debt default or something of that nature, which we don't think will happen here, but no one should be thinking that we have the tools to protect the economy from all the potential effects of that.
When asked whether the Fed would accept a $1 trillion coin to avoid a debt default, Powell said there are no rabbits to be pulled out of hats, and that would be a rabbit coming out of a hat. Now, House Republicans expressed concerns about reviewing and potentially increasing capital requirements for banks as well as the Fed's climate testing scenarios. McHenry questioned the Fed's motivation for the Fed's review and said that the Fed shouldn't operate in the shadows, especially when the regulation in question could have significant economic effects. McHenry also accused the Fed of laying the groundwork for climate policy implemented through Fed regulations. Now, this is the last time we will hear from Fed Chair Powell before the policy meeting in 2 weeks. Dave?
Jen Schomburger there with the latest from Mr. Powell. Thank you. The two-year Treasury yield spiked over 5% after the Fed chair testified before the Senate. It was the highest since June 2007. What does this mean about the economy and why should investors be paying attention? Yahoo Finance's Jared Blickery here to explain that for us. Hello, sir.
Hello. Well, with the next Fed meeting, the big one, only 2 weeks away, Jay Powell just dialed up expectations for a bigger rate hike in March from 25 bips to 50 bips, inverting the yield curve to the highest level in 4 decades. also dialing up recession expectations. But let's back up and review the basics as to exactly what the bond market is signaling, especially when it comes to recession odds. In normal times, lending money for longer means more risk for the borrower. It makes sense that someone lending money will charge a higher rate of interest, and that would be for longer-term loans as risk increases with time. But there are special times when the yield curve inverts. That's when shorter-term yields become higher than the longer-term yields. This usually leads to a recession a year or two later. Why? This chart helps explain, and it goes back to the beginning of the pandemic in 2020, showing the 2-year yield in blue, the 10-year yield in purple here, actually in blue here, the 2-year is in purple, and it shows the difference between them in gray. That's right there. The 2-year reflects increased short-term rates that the Fed is actually acting on directly, as well as future expectations of rate hiking. Now, we can see this 2-year started rising quickly in late 2021 and early 2022. That would be right in here, finally inverting briefly in the first quarter. That's when this gray line this gray histogram first goes negative. And then we got some hot jobs data coming in, increasingly hot. That destroyed the transitory meme, and the spread between the 10-year and the 2-year became more and more inverted. It just hit negative 100 bips or 1 percentage point for the first time since the early 1980s. That would be this point right there. Now back to the present. Powell just raised the red flag before Congress over the rash of hot economic data he's seen since the last Fed meeting, and the market has listened. This chart you're looking at right here, this shows the U.S. yield curve from 1 month to 30 years along the x-axis and how it's changed over the last 2 days of Powell's testimony. It's gone higher for the most part. The 1- and 2-year yields surged about 17 basis points higher, meaning the market is hearing Powell's worries about the hot economy and is reflecting those concerns with higher rates up to 7 years out on the yield curve. But notice the 10-year and higher maturities all the way up to the 30, they are actually lower. Eventually, bond investors know that the Fed is going to reverse course, pivot, and start cutting rates. All of this gets to the essence of what type of landing we might expect. We heard a lot of talk in January as stocks soared that we might get a soft landing recession in the back half of this year, or maybe no recession at all, a no landing. But the latest data is stacking evidence in favor of a delayed hard landing. And bond investors, they now expect the Fed is going to ratchet rates up and try to keep them higher for longer. Now, this sets up a feedback loop that makes it harder to borrow money. With tighter credit condition, it's harder to turn a profit, and some companies can't even make enough money to survive. They simply go bust. Fired workers and consumers retrench in this environment. They spend less. This gets inflation under control. So goes the theory. No doubt the economy is strong, and so is the labor market. But the big question for investors is, how hard is the Fed going to have to push back until something breaks? The message we got from the Fed and investors over the last 2 days is that the Fed is going to push hard and likely break something in a big way. But we might not see the damage in the economy for several quarters. So in the meantime, that makes it harder for stocks to meaningfully rally. Guys?
Very hard for investors to really quite figure out what is ahead. Jared Lickery, thanks so much for breaking that down for us. All right, well, we want to take a deeper dive into the market's reaction, at least for today, and taking a look at the 3 major averages. We're still looking at, it looks like all 3 of the major averages now lower. The NASDAQ flipping back into negative territory. And for more on that, we want to bring in Victoria Fernandez, Crossmark, a Global Investments Chief Market Strategist. So, Victoria, help us make sense of what Jared was just explaining, all the scenarios here, the hawkish rhetoric from Fed Chair Jay Powell, the most realistic, you think, or most likely scenario at this point in terms of a hard landing, no landing, or soft landing? What do you think?
Yeah, so Shauna, we're really looking at having a mild recession later this year. Originally, or back at the beginning of this year, just 2 months ago, we would have said that probably happens around the middle of the year because we would have anticipated that the Fed would stop raising rates probably after the March meeting, maybe the May meeting, and then go on pause. As we've seen as of late, all of those expectations have been pushed higher and further out on the calendar. So we do anticipate to probably see a terminal rate probably around 5.5 to 5 3/4, and we expect that to lead us into a recession later in 2023, third or fourth quarter, expecting no rate cuts this year at all. For us, That means there's going to be continued volatility in these markets. The Fed does not have their playbook etched in stone at this point, so it's a battle as to what they're going to do going forward. The bar was raised or lowered a little bit after Powell yesterday, opening that door for a 50 basis point move. But I think so much is going to depend on the labor report this week and on the CPI numbers next week before we can really take a better guess at what March holds.
And what about inflation? Do you see it getting back to 2% or see Powell settling for something around 3 plus?
You know, this is the huge question that we have. When we talk about having a recession later this year, the one thing that we say can prove us wrong, and we wouldn't mind being wrong on saying that there's a recession, what could change that is the Fed pausing sooner rather than later, saying, you know what, a 3 handle on inflation is something we can deal with. Let's get to that point and let's stop. For right now, Powell is saying that is not going to happen. They are steadfast to get to that 2%. If they push to get to 2%, then I think we definitely go into a recession, and maybe it's more than a mild recession. But let's look at some of the data we just got this week. Used car prices, Manheim came out with their used car prices up 4.3% month over month in February. That number was down 2% in the January CPI report. So I'm telling you that when we look at these services numbers and these core numbers, some of the underlying elements, it's telling us we are not in a permanent disinflationary environment. We're going to see some of these pricing and these inflationary pressures continue to go higher. The strong labor market, wages, rents, all of these things that eventually will cool off. I don't think it's going to be imminent. So I think we need to be watching for higher CPI numbers that will push the Fed even further.
Victoria, you say eventually. There were several questions from both sides of the aisle today about the Fed using lagging versus leading indicators. Does that concern you at all, in particular when it comes to rent?
Well, there's a lot of elements in the market that do have that lagging effect, and even rate hikes themselves have that lagging effect. You know, we hear people say that it's 6 to 9 months. Some people say 9 to 12 months before a rate hike actually works through the economy, which is one of the reasons that I think the Fed will be cautious in going 50 basis points at the March meeting. We've still got 450 basis points worth of hikes that need to work through the economy from a year ago. So I think that, yes, there's lagging things that need to work through. Rents is one of those, and I understand that. But you look at leading economic indicators, those have been down 10 months in a row. So I think you get it from both sides, leading indicators and lagging indicators. There's some concern on both sides of that. So obviously, take the lagging ones with a little bit of a grain of salt in the fact that it's going to take longer to see those work through the economy. But the Fed knows that, and they're paying attention to that.
Victoria, you have a list of stocks that you like and stocks to avoid in this environment. Let's start with the ones that you trust. You have a group of consumer staple names, also healthcare names, and consumer spending. What are they and why?
Yeah, so we think because we think our outlook is the way it is, and there's going to be a lot of volatility in this market, you need to have some exposure to some staples, defensive names, and some cyclical names to take advantage of some of the upside that we'll get in bits and pieces. So you look at a name like a Lowe's, you look at a name like a General Mills. These are good staple names in your portfolio. Yes, they have some exposure to the consumer, and the consumer has been quite strong. Their balance sheets are strong on the consumer side, and their corporate balance sheets for these names are strong as well. So we think those are good additions. We also like healthcare, the HMOs. And I know people will say, why? These have been hammered this year, but that's part of our thesis. They have underperformed. They're now priced cheap relative to the rest of the market, but they do have above average growth, and their earnings were pretty decent. So if we can get a stock that has a good balance sheet, good growth at a cheaper valuation, then we think names like a Cigna or an Elevance Health are good options. And finally, we like credit cards. MasterCard and Visa are names we like, but they're a little rich right now, Shauna. So I would say maybe put those on your wish list. See if those valuations come down a little bit more, then you can add those.
You speak of consumer spending. One thing they are spending on at record rates is travel, but you are actually not all in on the sector. What are some names and why?
Yeah, so I think actually you look at airlines, you look at hotels, these are sectors that we would probably start avoiding or at least trimming. Airlines were up yesterday on the news on the JetBlue Spirit merger. And so I think you could trim a little bit of those names. We have seen tremendous demand there. And I'm not saying it stops completely, but I think we're going to start to plateau a little bit there. And especially if we go into a recession at the end of this year, those discretionary trips are going to be the things that get pulled back first. We're actually short Choice Hotels and American Airlines. So we think there's some definite downside to these sectors going forward for the rest of the year. We would be cautious there.
All right, Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Thanks so much. We're just getting started here on Yahoo Finance Live. Coming up, the push for diversity in the boardroom has slowed. We will talk to Jennifer Siebel-Newsome on her roadmap for diversifying corporate boards. Then the economic catastrophe behind COVID-19. Semaphor's Liz Hoffman joining the program to tell us how some of the world's largest companies survived the pandemic without a playbook. And Tesla shares taking a hit today after reports of steering wheels falling off of Model Y vehicles. We're going to have the details for you and the pressure that we're seeing on the stock just ahead. Let's get to a part of the business world that still has a lot more work to do. Now, we are talking about women in leadership positions here in the U.S. Did you know that women account for about 30% of board seats? Well, that's less than just a third. Sure, 34 more seats have been added in the first 2 months of this year for S&P 500 companies, but we are still not even close to where we should and where a lot of us want to be. And that is actually losing momentum. Now, the rate of increases has declined over the past 3 years from 2% growth in 2020 to just 1.5% last year. This is a stark contrast to progress that's being made in other countries overseas. Denmark and Germany saw a spike here in the number of women in the boardroom. Danish companies saw the highest increase in women on boards from 35% of board seats held by women in 2021 to just over 42% in 2022. And here are the other top three. You have France at number one, just over 46%, and Germany in the number three spot at just over 35%. So what's going on in the U.S. right here, and what are some of the biggest issues? Well, most European countries have mandatory gender quotas, but the United States, We do not. And that's not all. Most companies don't have board term limits. In fact, only 7% do. 30% of U.S. companies in the U.S. don't even have retirement requirements. Right now, fewer than 500 seats change hands each year. That leaves very, very little opportunity for quick, significant growth. So how do we get more women on the boards, and what else do we need to do to help better that ratio? For that, we want to bring in Jennifer Siebel-Newsom, first partner of California and also co-founder of the California Partners Project, a nonprofit focused on promoting gender equality. Jennifer, it's great to have you here. Just give us a better sense of some of that progress that we have made and the payoff that companies do see when, in fact, they do have diversity on their boards.
Hi, thanks. It's so great to be here. Well, look, the payoff of having more women on the board is greater creativity, productivity, and a better bottom line. You see better environmental, social, and governance practices when you have more women in public company board seats and in private company board seats. So all of those are positives. And what we're seeing here in California is that we've more than tripled the number of women in public company board seats and doubled the percentage of women in seats. And that has to do with the increase in public company boards in California. So it's really, really exciting. And we obviously have work to do, especially when it comes to women of color. Latina women represent about 20% of the population and only hold 1.8% of public board company seats. And so we have work to do in that realm as well with other women of color. So it's the progress is great, but there's still so much work left to do.
Happy International Women's Day. Jennifer, California's proposal was recently shot down that would require boards that were public companies to have up to 3 women per board. Is that the right way to go about it, in effect discriminating against men? Or do you think there are other ways that would be a better way to go about it?
Well, look, I think what's so wonderful is that we passed SB 826 and as a result of that, moved the needle forward in terms of representation. As I said, when we started, about 30% of the companies had 0 women on their boards, and now about a third of California public company board seats are held by women. So we've made progress, irrespective of this legal dance, this legal battle that's going on. You know, I'm a proponent of policy and cultural change going hand in hand. And that's really what's happening in California, because we know that there are so many benefits to women in leadership. And I think that's why we've been successful despite some of the challenges.
Jennifer, you recently rolled out a playbook, a real step-by-step plan on how to get more women on boards. Let's start with step 1. You're saying find the gaps, update and use a board skills matrix. What exactly does that entail, and what's the benefit there?
Well, so it was so wonderful to partner with my alma mater, Stanford University, on designing this playbook about recruiting, onboarding, and retaining diverse women in public company and private company board seats. So we really are about best practices. And some of these are really nuanced strategies for how to ensure success in this realm. And it's about, dismantling the old boys club network of just, bringing onto the board somebody that is in your inner circle that you play golf with on the weekend, and really, again, growing the network and the potential of a company through who sits in those seats around that table of power. And that's what the playbook it really offers are all the very nuanced and critical steps to ensuring that you have the most diverse board possible that's going to help your company get to the next level. And that's really going to reflect the population of consumers. Let's not forget that women are 86% of consumers, making the majority of household decisions. And yet the people historically that have been making decisions around the products that are created and marketed aren't made by that mother, that woman of color that has this unique perspective and life experience that she can bring to the decision-making table.
Okay, I think you covered 1 and 2. Let's get into 3 and 4 now. Create an equitable interview process and onboard internationally. First, with number 3, what needs to change in the interview process?
Oh, well, There's a lot that needs to change. I mean, I don't really know if I should get into the specifics here, but some of it's just intuition. When you are, onboarding, when you're interviewing someone, you really want to be thinking about what, aside from their gender or their race or their previous experience, is unique to them that they can bring to fill a gap or a hole in your company's strategy. And again, we've all seen that when you have more diverse women in leadership, you have greater environmental outcomes, the community and the social practices at the company, the family-friendly practices are improved, so you're more likely to retain that workforce. And then again, there's less risk when it comes to governance. So these are some of the things that you want to kind of pull out in the interview process. And again, because women have been excluded from these tables of power, we've been missing, the perspective of really the 51% of the population.
Jennifer, when we talk about getting more women on board seats or filling those board seats, more women in that CEO role, what is your advice, that fearless advice that you would give to other women out there trying to work their way up the corporate ladder?
You have to believe in yourself. You have to know that you deserve to have a seat at that table, and that your voice and your perspective is essential for human progress and the success of that company. And it's just really about, believing in yourself and knowing that you belong.
Jennifer Siebel-Newsome, nice to see you. Appreciate all that advice. Coming up, the financial carnage of 2020 left some of the world's biggest companies on the brink. Semaphor's Liz Hoffman tells us how they managed to survive next. Let's get a quick check of the market, sponsored by Tasty Trade. A lot of red on the board, albeit just marginally on the S&P and the NASDAQ. both down just fractionally, while the Dow is down 183 points. The Labor Department's JOLTS data showed a slightly cooling labor market meanwhile, but still one with 10.8 million job openings, or 1.9 job openings per available worker. Let's talk about the economy with Semaphor's Liz Hoffman. She's the author of the new book, Crash Landing, the inside story of how the world's biggest companies survived an economy on the brink. Liz, nice to see you. We'll get to the book in just a moment. First, what do you see happening with this economy? Any chance the Fed chair can cool off that labor market? Just about 2 jobs per available worker.
Yeah, the Fed has had a real hard time with the labor market. You've seen the openings cool a little bit, but still about double what they were before the pandemic, and just absolutely no sign that the wage war, the talent war, is cooling in anywhere outside of Silicon Valley, where there's frankly a lot of slack. It's just been incredibly hard, and the one place I think the Fed's had a little more success with its playbook is in the housing market, but again, that's the most rate sensitive corner of the economy, and things that are, a little bit trickier. They're really pushing on a string with a lot of the labor stuff.
Liz, when it comes to a more aggressive Fed that raising the odds of a recession, how do you see that, and how potentially bad or deep this recession could get if the Fed doesn't let up anytime soon?
I think it's just worth pointing out that they're willing to put the economy into a recession. I feel like we don't say that out loud enough, and the market seems constantly surprised by that. That may well be the cost of this. Most people I talk to think it will be, to the extent we're in one now, pretty short and fairly mild, and we should be snapped back, by later this year.
Okay, so let's talk about the book, Crash Landing, in which there was no playbook, as you point out, for CEOs to handle the devastating circumstances. And you talk about how some of them did manage their way out of it. Let's start with Airbnb's Brian Chesky. What did he do in the midst of all the chaos?
Airbnb is such a fascinating story. They had come into 2020, expecting to go public, the biggest event in a private company's trajectory. They were going to join, the pantheon of Silicon Valley unicorns. And Brian Chesky had spent the holiday season coming into 2020 with a pile of prospectuses, kind of figuring out what story he wanted to tell. And the one he landed on was that this would be the year of connection, which has just always struck me and stuck with me as I reported the book. And then bookings just fell off a cliff. The idea that you would, frankly, leave your home for a while and go to a stranger's home seemed insane to a lot of people. He did 2 things. He raised money in a pretty humbling way, raised $2 billion from private investment firms in April of 2020, required a major cut in their valuation, which is something most tech CEOs are pretty reluctant to do. And then pretty quickly pivoted, I would say got a little lucky, but recognized that in fact people did want to travel, but they didn't want to go to a hotel in Las Vegas. They wanted to go to a cabin in the woods for a month. And so they pivoted to long-term stays very quickly, and really were back on the IPO track by that summer, went public at the end of 2020 at a just monster valuation. And so to me, it's a lesson in acting quickly, jumping on the trend when it looks favorable, and really kind of seeing that process through.
So Liz, sticking with the travel sector, but more specifically looking at the airlines, American Airlines CEO Doug Parker, very committed, making multiple trips to Capitol Hill to secure that multi-billion-dollar bailout. What did we learn from him and what that tells us about the airline industry today?
Doug Parker lived in the Willard Hotel for a lot of 2020. Should start by saying that American in particular came into this crisis in a fairly weak position. So, the government aid was for them in particular absolutely crucial. But stepping back, airlines, I think coming into 2020, there was this sense that they had kind of escaped the boom and bust cycle that is so core, unfortunately, to that industry. They are in the business of flying gigantic capital-intensive hunks of metal around and are constantly lurching from one crisis to another. Look, I think there's a fair amount of criticism that you can levy on the airline bailout, which is fundamentally what it was. But just think about how much the sort of travel hell of 2021, 2022, to the holiday meltdowns that we saw at Southwest, I would just caution people to think about how much worse that would have been had this industry, which is heavily unionized, heavily regulated, and training and hours and compliance, had gotten thrown off the rails. The cost of doing that, of course, was that, just goes down as another instance of moral hazard and gives everyone another excuse to frankly hate on the airlines, which is a perennial villain.
The U.S. auto industry was bailed out long before, and two CEOs had to navigate COVID. Jim Farley, who's the CEO now, and formerly Jim Hackett. What were the circumstances facing them, and how'd they handle it?
Ford came in to the crisis incredibly indebted, and sort of strategically had lost a lot of ground to companies like Tesla, a lot of the EV startups, a lot of Chinese car makers. So they had both a financial problem and a strategic problem. The financial problem largely solved itself when the Fed effectively agreed to backstop a huge portion of the corporate debt market. In particular, Jim Hackett had been putting out feelers in Washington. If you'll remember, an early Fed program had agreed to put Fed money behind very high-rated corporate bonds. Ford had lost its investment grade credit rating fairly early in the crisis. And Jim Hackett did some very quiet lobbying and got a tweak to that rule that allowed the Fed to effectively backstop Ford debt. And they did the largest junk bond offering in history. The other part of the Ford story that I found compelling, Ford is a company that just sort of oozes Americana. They made bombers in World War II. They made iron lung for polio patients in the 20th century. There's a lot of criticism, fairly, I think, about companies sort of pursuing the last penny at the cost of sort of bigger ideals. But Ford has actually always remained fairly true to that DNA. And they stepped up and said, look, there's something we can do here. And they ended up making ventilators, face shields. They used batteries from their power tools and basically pieces of F-150 air conditioning systems, and they made these respirators to help purify the breathing mechanisms for first responders and really help keep hospitals staffed. So I think they deserve a lot of credit for that.
All right, nonfiction books about leaders persevering, my favorite personal category. It ain't even close. The book is Crash Landing. She is Liz Hoffman. Appreciate you being with us. Looking forward to reading. You got to get us a few copies, Liz.
We'll send them over. Thanks for having me.
Look forward to reading. Coming up, shares of Stitch Fix are falling today. Piper Sandler citing two major headwinds for the styling service. We'll break those down next.
It's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Stitch Fix, Adidas, and Campbell's. Let's kick it off with Stitch Fix. A day after the retailer reported a 20% drop in revenue. Piper Sandler is saying that the weakness points to, quote, foundational issues within the business, and also saying that we could continue to see near-term pressure. 2 big challenges facing a Stitch Fix: a limited total addressable market, this is from Piper Sandler, and also mixed success with its Freestyle business. If you're not familiar, that's a personalized shopping experience that they do offer based on their fit and their size. Stitch Fix reported a wider than expected loss, and also announced another executive shakeup here in their most recent earnings report. Dan Jetta is stepping down from his role as CFO at the end of the month, about 2 months after Elizabeth Spaulding, the former CEO, left her position. Founder Katrina Lake is currently serving as the interim chief executive. This is a company that has been up against a pretty tough couple of quarters. They have been cutting costs now for quite some time. Just announced their second round of layoffs. From this latest earnings report, doesn't look like they've been able to turn around their business just yet.
No, there's a lot certainly to be settled out there with Stitch Fix. And honestly, the move from Stitch Fix to Roku is an interesting one too, because you talk about another company that sort of shot up during the pandemic. Roku at a little bit of a different stage than Stitch Fix, but still a growth stage company that there'll be a lot of work to do there as well. I'm taking a look at Adidas today, closing the day higher actually on a bit of a upbeat comments about the future and also some of the fallout from the company's breakup with Kanye West. So that kind of already being baked into the stock price today. And so really what happened here, Dave, is the quarterly numbers came in pretty ugly. And so net profit for all of 2022 falling more than 80%, revenue growing just 1%, but that was after the company initially guided for about 20% growth on the year. And the company reiterating it could lose more than $750 million in potential profit this year if it completely withholds all of its inventory related to Yeezy. And that's where I want to zone in here, is that Yeezy inventory. So we did not learn a lot more about what they plan to do with it. They're still basically debating, do they sell the Yeezy inventory? Do they put more of it out there? Do they just hold it? It's worth over $1 billion in sales, they've estimated. And one interesting note from the call, they said that they've had over 500 corporations reach out about it. And basically they don't want to donate the shoes, because I think that's where a lot of people think you could go, right? You donate the shoes. Shoe resale value is huge. People would get them as donations, and then next thing you know, more Yeezy merchandise is going to be online, and people are going to be looking to sell them. And Adidas really just doesn't want these shoes out there, especially in that capacity.
And that's literally what the CEO, Bjorn Gulden, talked about on the earnings call. He's got a massive challenge on his hand. Just took over January 1st, their brand new CEO. There's literally talk of, no doubt, no joke, burning the shoes. To your point, now they've spiked on the secondary market. They're not going to find their way out of that problem. One word: messy. How have they not capitalized on the most popular athlete on the planet with 400 million Instagram followers, with the most liked Instagram post of all time? I'm really surprised they haven't found a lifestyle shoe. Yes, he has a cleat to wear on the field. You literally have the most identifiable popular athlete on the planet. Build a shoe line around him. No one needs my advice on shoes, but I am offering it.
They actually do need your advice.
That's a good idea.
I think it is an absolute no-brainer for Adidas.
Yeah, it would make a lot of sense. I think the one criticism of Gulden on this call was a lot of his vision in terms of that product innovation that we know is so important to him. That lacked a lot of the detail. That was kind of the feedback here from analysts today. But certainly, they need to do something to turn it back around and get more competitive with a name like Nike out there, light years behind them.
They do have an $830 million sponsorship deal with the MLS that just started, so they're really going to have to lean into that and hope that league can succeed. That looks to be the short-term path forward. My play, meanwhile, CPB, Campbell's Soup, turning in a hearty earnings report, topping expectations on revenue and earnings per share. The stock up just about 1.5% on the day, said their CEO Mark Klaus. Quote, consumers continue to seek out our brands as they look for ways to stretch their food budgets and turn to value-driven meals that are easy to prepare. U.S. soup sales rose 7% in the second quarter. Campbell's, though, is facing growing competition from cheaper private label counterparts. Quote, anytime we're losing share in the category, I'm not happy about that, Klaus said, but added the company was taking steps to regain share. Those steps include innovation. They are appealing to a younger generation with a product that I have right here. I have not tried. It is called Ghost pepper chicken noodle soup, which debuted as part of a contest in January. It was so insanely popular, Campbell's added it permanently coming this summer. Said their chief, it said, it's going to be one of those things that really is a new chapter for us, said their executive chef. So we're going to try it. Initially, you had to sign a waiver.
I read
I don't know how I feel about
because
the waiver.
it was so hot. So I'm nervous about it. I don't.
You heat up the soup? That's what I want to know. Are we gonna have cold?
We're not eating cold soup. We're not eating cold soup. Dear God.
Is that hot?
It is delicious.
Oh,
God.
He's going to need some water.
It is delicious, but my God.
Oh my God,
it's
it is hot.
Spicy?
Wow. Yeah.
Oh my
you
God.
Have to do you want
Are we sharing spoons? I'll
we
try
have
it.
to.
I'll
It's
try it.
tough times here. We only have 2 spoons.
Oh
There you
God.
go.
That is,
trying the broth.
it's really good, but I'm not a
Really?
spicy guy.
Spicy.
It's way
spicy.
too spicy to eat. Imagine trying to eat more than just that.
Imagine
little-
having the can.
I'm sweating.
Also, who is this appealing to? Who out there in Gen Z or the younger generation? Now you're drooling on your
Oh God.
Just to give everyone a real good look or good sense at how hot this suit was. The camera panned for 1 second. Dave was drooling on his suit, and now he's profusely
sweating.
You are sweating. All right.
Wow,
well,
they did a good job. Young kids love
this hot.
extraordinarily hot things.
Though? Okay. Do you?
I kind of like the
Gen
spice.
Z.
I don't know if I could eat the whole can.
No.
Fun innovation.
Well, we'll see. There are a lot of fans out there of this. All right, guys, we got to move on, though. Coming up, if you're still planning to book your flights for spring break, your wallet could take a beating. See how high prices could potentially be when we come back. Inflows into U.S. sustainable funds hitting the lowest level in 7 years last year in 2022 amid growing backlash against ESG investing. This is according to a report from Morningstar. But despite that dip, plenty of investors are still buying them. So let's talk about it. What exactly are they? ESG standing for environmental, social, and governance, and it's the criteria used to evaluate a company's sustainability efforts. Now, one way to invest in ESG is through an ESG ETF or an exchange-traded fund made up of a basket of these types of companies that are prioritizing sustainable causes. Now, these funds cater to investors who want to put their money towards issues that are important to them. Investments typically include in these areas for the portfolio are efforts that they prioritize in climate change and carbon emissions, energy efficiency, gender and diversity, and also human rights. So for more on this space and the investment opportunity there, we want to bring in Lisa Lake Langley, Emerge Capital Management CEO and founder, as part of this week's ETF report, brought to you by Invesco QQQ. So Lisa, break all of this down for us. You have 5 ESG ETFs that trade here in the US, and I believe they are all managed by female fund managers. So talk to us just about your strategy and why you chose to go with the female fund managers, why that's a priority.
Diversity is a key tenet at Emerge. I'm a majority woman fund company owner. We launched on September 8th and 9th, 5 ETFs in the US and 5 in Canada, the exact same strategies, so that we would make more of a bang, because we wanted to send a very important message to the industry. There is no other program anywhere in the world that just features women portfolio managers. And I've had calls asking me if this is legal. I've had advisors asking me, shouldn't we just be focusing on performance? Why are we focusing on gender? And there's such an industry problem that we have to educate about it a little bit, and they deserve an opportunity. Only 5% of assets in North America are really being managed by women. Less than 11% are actually women portfolio managers. And all this is based on self-reported stats. There is no regulatory compulsory reporting, and that's where the issue lives, right? How do we know that women earn 83% on the dollar, for male and men in similar positions? Because that information is reported. But in the investment industry, you're just a innocuous investment professional. So,
but don't you have a fiduciary duty not to concentrate on gender, but on returns?
I have a fiduciary duty to do what's in the best interest of our unit holders and to identify extremely experienced portfolio managers. And all of these women have over 20 and 25 years of experience. They've managed assets actively in all kinds of climates. They may be new to the ETF space, but these are not, newbies for portfolio management. All very, very senior, have, Morningstar, publicly available information. Anyone can find it.
And Lisa, when it comes to ESG investments, really overall, there certainly has been some backlash as that topic has been debated, just exactly what companies are using the criteria, whether or not those specific investments should qualify. Are you confident that we are on a road kind of to rebuilding that trust, and that investment interest in ESG is only going to grow from here?
I think the rebuilding of the trust and establishing regulation and getting more scrutiny is an extremely part of anything that's newer, right? What we have had in this greenwashing issue is that companies weren't as aware of all the need to do the detailed work. Every one of our stocks is reviewed and approved. We've hired very talented portfolio managers who are suggesting stocks, and then they're going through a separate team that is also looking at the sustainability features. And we have a practical approach, right? Like, we wouldn't have planes in the sky if we didn't have fossil fuels, but we look for responsible refiners. And what's really important to us is looking for gender and diversity, making sure that companies have good social practices, they're good constituents of their employees and their clients and their communities.
What are some of these funds and what sets them apart?
What sets them apart is they're all actively managed.
If you could name some of them
Yes,
in that process.
okay, perfect. So one of them is called Empower Unified Global Equity, and that buys the individual holdings of each of the underlying 4. And the underlying 4 are Catherine Avery is running sustainable large cap dividend. She calls them dividends with a purpose. Kate Faddis is running our select equity growth. And then we have Josephine Jimenez with emerging markets. And Jane Lee at Zevin is managing our global core. Everybody is off to a very strong start, even though we launched in September, which was kind of like the brave of the bravest, head out.
Certainly, and still is at this point with all that uncertainty out there in the markets. Lisa Lake Langley, great to have you. Thanks so much for joining us here. Emerge Canada CEO and President. All right, we are counting down to the closing bell on Wall Street. The Dow in negative territory, but the S&P and NASDAQ back in positive territory, with the NASDAQ up nearly 0.5%. We'll be right back.
All right, just a few minutes before the closing bell, Yahoo Finance's Jared Blickery here to take a deeper look at what's moving the markets. It was an interesting reversal in just about the past hour. What went on?
Yeah, it looks like, as you said, a little bit of a reversal here. Here, the Dow is still underwater, but let me put on a two-day chart, and we can see a little bit of a jump in the final hour, but really more pronounced in the NASDAQ, which is now positive on the day. That's up 35 basis points. Here's today only, and you're going to see it rose to the green, had been in the red at the beginning of the last hour. So yes, reversal of fortunes, but we're not talking about huge percentages here. It was really yesterday's big loss that I think is more informative of the move. You can see still mired here in the bottom 1/4, I would say, of that range. Now, today and yesterday, all about Powell speaking before Congress. And here is the 13-week T-bill yield. I'm focusing on this because this is a short end of the U.S. Treasury curve. This has been very responsive to what Powell has been saying. And over the last 2 days, it has really shot up. So it's up 4 basis points today. It was up a multiple of that yesterday. You can see these huge 2 green candles here. Put a max chart on so you can see this is the highest level since, guess what, 2007, right before the global financial crisis. No need to get into yield curve inversion talk just now, but I want to go to the S&P 500 and put a 6-month chart in so I can draw some trend lines here. Actually, let me dial this up to a 1 year, and we can see we are still in this trading range that we have traced out here. 200-day moving average back in play, not shown, but right underneath current levels. So kind of at a Rubicon for the the S&P 500. NASDAQ, a little bit different story. It's flagged, but you can see the last 2 days have not erased the big 2-day gain that we had last week. Let me just go to some heat maps so we can kind of get a visual view of what's been going on. Defensive setup here. Real estate, that is interest rate sensitive. That is up the most. That's up 1.4%, followed by utilities, also interest rate sensitive. But then tech, materials, industrial staples, all of those outperforming. So kind of a weird mix of tech and some defensive sectors. And let me just show you what's happening inside the semi space, because that's where I'm seeing a lot of this tech action center. We got AMD up 4%. We have NVIDIA up nearly 4%. A bunch of other strong names in here. Compare that with software, and you're not going to see nearly as much dark green, although we do see more green than red here. Microsoft notably down about 2 basis points. Let me round this out by just showing you the NASDAQ 100, where we are generally. Tesla is also standout. That stock down just about 3%, and just a few seconds more to the bell. Let me just put you on our travel page, and here is that closing bell on Wall Street.
All right, well, that wraps up today's trading day. Again, the Dow closing in the red, off just about 55 points. The S&P and the NASDAQ holding on to gains. As you can see there, the S&P up just about 0.1%, as well as the NASDAQ. So a little bit of a relief rally here, relief gains that we are seeing after yesterday's significant sell-off. Some investors there worried about the Fed getting a little bit too aggressive after the hawkish tone that we've heard from Fed Chair Jay Powell testifying in front of the Senate yesterday, in front of the House committee today, about higher rates and that higher for longer rate environment. This market's check sponsored by Tasty Trade.
Okay, shares of Tesla trading lower on the day after the National Highway Traffic Safety Administration opened an investigation into a malfunction of a 2023 Tesla Model Y steering wheel. As you can see, 3% drop on the day. Our senior autos reporter, Praz, remaining here with that story. So, Praz, a steering wheel falling off, that sounds like a problem. Huge. That sounds like the most terrifying thing on the planet.
Yeah, you got to steer, I think, right?
My
You
God.
got to steer. So yeah, apparently 2 instances of 2 separate cars, the wheels came off the column while the driver was using the car. So potentially a serious issue here. Apparently the retaining bolt was missing from the factory when the cars were delivered. So that's the problem. The fix apparently was just to reattach wheel, put the bolt on. The question is, how many cars out there have been affected by that? We don't know. Data firm Motor Intelligence says that Tesla sold 252,000 Model Ys in the US last year. So the question is, of those, how many of those might need this retrofit fix, put the bolt back in? A serious issue there. I think they're going to be investigating very, very soon right now. One thing I will say, though, is that this sort of follows that big full self-driving recall that we saw just a few weeks ago, 300,000 vehicles, right? And then just today we saw that NHTSA opening up a special investigation into another self-driving incident with the car crashing into a fire truck in Costa Mesa, California. So a lot going on there in the safety end.
A lot of issues there
Steering
in a
wheels,
short period of time.
Yeah, and steering wheels falling off, that's going to be enough to make you second guess if you were planning to buy
a retaining bolt in a steering wheel. I'm no autos expert.
Yeah,
That's
scary.
pretty essential.
Yeah, exactly. All right, Praz, while we have you here, let's talk about what's going on in the used car market, because prices had been falling for some time. Now, though, it appears that they're ticking back up. What's going on?
Yeah, so Manheim, which tracks the wholesale auction market for used cars, says that for February, the second month in a row, they've seen car prices actually rise month over month. This is a surprise to them, 4.3% from January, biggest monthly gain in February since 2009. So this is not a small number here. They're saying that these elevated numbers are sort of happening because of the fact that potentially they're seeing demand pick up at the dealer level, at that used car dealer level. Sometimes you see that in the springtime, it's seasonal buying. Tax refunds coming in. Those are the kinds of things that make people want to buy cars in the spring. So that's pretty interesting there. Also, new car prices are chugging higher still, 8.7% year over year. That's Cox Automotive. So that market's still kind of on fire still. But now the used market, maybe a little bit of bid there, people wanting those cheaper cars.
If Mr. Powell needs another reason for a 50-point hike, he may get it in the auto industry. Not that he needs it. I think he's already there.
I think he's there. I think it's safe to say. What do you
Maybe
think?
another
He's there?
nudge.
50?
I think Jen Schomburg should ask about the Chevy Chevette, right? 1982 rising in prices, so we'll see.
There we go. A curveball of a question, President Marine. Thanks so much. We also want to talk about Molson Coors shares closing the day higher, giving back, though, some of its initial gains. You're looking at pop at just about 3% today. The company clearing up some confusion that had been swirling this morning about a potential activist investor looking to take over the company or take a stake in the company here. The excitement today started from a recap of an analyst note published online, the article highlighting a new risk factor in Coors' SEC filing. So Coors saying in the filing that, quote, shareholder activism efforts or unsolicited offers from a third party could cause a material disruption to its business. But Don Bilson, he's an analyst there behind the initial note, telling Yahoo Finance that the note was misinterpreted. He added that the note in his note here that Coors is a controlled company, meaning that Coors and the Molson families, they pick about 80% of the board. Therefore, an activist takeover would be highly unlikely, Dave.
And Coors reiterating to Yahoo Finance that while there was a change to the risk factors in the filing, that doesn't actually mean there's an active risk or potential sale on the table. A Molson Coors spokesperson telling us via email, quote, we routinely review our risk factors for updating in our SEC filings. There's nothing specific to call out other than that the risk language was prompted by the SEC's new universal proxy rules to which every public company is subject. Coors shares giving back, as we said, some of their gains. They were up 5% at one point, but Shauna, that's still a pretty significant gain at nearly 3%, which leads one to believe that investors aren't entirely dismissing the notion of some buyer flying around. That's based on no other news. There is no other news related to Molson Coors, no upgrade. So a nearly 3% gain certainly indicates that investors see something on the horizon. The beer market is certainly not the reason for the excitement.
Yeah, maybe investors got a little bit too hopeful here in terms of what a potential takeover, what that would potentially do with Molson Coors' business. Because when you take a look at even just the 6-month chart, we're looking at a gain of just over 4% over the past year, pretty much equivalent there. Over the past 5 years, we're down about 32%. So I think investors are looking for any sort of way that Molson Coors could potentially boost its business there. Obviously, some of the pressure, some of the challenges that Molson Coors is up against, many of its competitors in this space also facing the same headwinds there. But investors are a little bit too optimistic, I think, about that initial report.
$11 billion market cap, certainly attainable, not to add fuel to the speculation fire, but I just did. Coming up, more women are returning to the workforce, but some are looking for a new path. Our next guest explains how to successfully make a career pivot after the break. Well, the pandemic was particularly painful for female workers, losing 12 million jobs compared to just 10 million for men. But women are staging a comeback in that regard, having now gained more jobs than men for 4 straight months and clocking in a shade below 50% of non-farm payrolls, a number women last tipped in 2019. Emily Tish Sussman is the host of the She Pivots podcast and a contributing editor of Marie Claire. Nice to have you here. Season 2 of the podcast rolls out today. We're going to get to that in a minute. It's about the pivot. Are more women making the pivot? And is that partly what we're seeing in these jobs numbers?
It's exactly what we're seeing. What happened in the pandemic is that it broke all of us to some degree. And a lot of women, particularly those that had children at home, young children in particular, felt like what I thought, the basis I thought I had, it doesn't exist. It's not working for me. But now they're coming back into the workforce and they're rethinking their lives. They're rethinking their engagement. If I'm going to be spending my time outside of the home, if I'm going to be having my children see me breadwinning, it needs to mean something. And so they've tried to figure out what they want to keep in their careers and what they have to get rid of. So they're rethinking their careers.
And you did it. You pivoted your career and you were very successful at it. What did you do? What was it like? And any advice? Let's start. What did you do? Start with that.
So I did political strategy for about 15 years. So I actually did segments like this on cable news almost every day for a long time. And I'm one of the women. I know that it broke women because it broke me. I had 3 kids in 3.5 years in a very busy presidential election. I could not do my job and I left Washington. And so I started to think about what are the stories that I needed for inspiration. Like I had done everything professionally right and I was at the top of my field and I still couldn't do it. So I needed to hear stories of inspiration of women who had changed their careers for personal reasons, not because they weren't professionally cutting it. So I thought, well, how do I get all of my idols to talk to me? Put them on a podcast.
Now, I think politics broke you because it broke all of us, quite frankly. So your podcast, you have everyone from Kathy Hochul, the New York governor, to the vice president, Kamala Harris, and even a social media star turned businesswoman, Kristen Cavallari. Is there a common thread among these women when you interview them in terms of their resolve or characteristics or?
Well, the reason that we bring women on the show is because they made a career change for a deeply personal reason, not a professional reason. So now we look at them and we say, oh, they're so successful. Everything must have lined up for them. But we have them walk through their journey and their perspective and show how something that had been oftentimes traumatic or at least quite dark for them really led to their perspective shift. And it's only because of that perspective shift that they found the success that they found. They couldn't have done it without it.
I think a lot of women are struggling with this. They're trying to figure out the right time to make that career shift. If it's one of the women out there who are listening, what would your advice be in terms of the timing? When is the time right? Is there ever a right time?
That's exactly the right question to be asking, is that everybody has something in them that they can change. If it's not working for you, you absolutely should change it. But everybody has to be realistic about their financial circumstance, their time commitment, their bandwidth. So it may not be walking in Jerry Maguire, like throwing it all, burn it down, walk out. That may not be realistic for you right now. Maybe it starts as a side hustle. Maybe you need to learn more about the industry, the terminology, the calendar of the industry before you can jump into it. So mapping that out and seeing that as a legitimate part of the journey, I think is an incredible first step. And it's realistic for women to actually make the jump that way.
Step 2 is make your coffee rounds. What do you mean? And how does that play out?
I love a coffee round. I think that everybody needs to
I've had 4 today.
Look, everybody needs to put together their group that they go to that helps them understand not just the industry that you're breaking into, but also the people that really know you. Like you may have skills that you don't consider to be skills, right? Like it's part of this LinkedIn put motherhood on the resume. Look, I had 3 kids in 3 years. I can multitask like you cannot believe. Like I thought I was good at it in the workplace. I'm on another level right now. And that's something that I can take into a job and but I don't think I would have recognized it in myself had my coffee round, had my personal cabinet not pointed it out to me.
I'm with you. I'm a mother of two, and I never realized the benefit and the ability that I had to multitask until I did have those two boys. Emily, when we're talking about success, how long it could potentially take, because I think a lot of people are hesitant about that, how much time should someone give themselves when they are looking to meet that pivot?
Well, it totally depends on what your version of success is. And I actually think that that's a key piece of it. A lot of people just want to be able to have flexibility now and own their time and not have long commutes. And that is their version of success right now. So I think it's totally circumstantial. Of course, it will take time to break into any new industry. You won't necessarily have to start at intern coffee level, but you may have to do a little bit of work, like a little bit of pro bono work into the industry to get your footing in it, both to understand the industry and for people in the industry to know you. So I think you can anticipate taking a little bit of time in there, but again, it really does matter what that version of success is for you. Like an Etsy shop might be your dream, you can jump right in there.
I want to be a TikTok influencer, but that's a whole nother show.
I'm not sure I have that for you.
How important is it to evaluate your financial obligations before you make that pivot?
It's an incredibly important piece of it. It goes to the point of, can you take something full-time? Do you take something part-time? What level may you have to start at? If you're pivoting into a new industry, not just a new job, you're likely not going to start at the same compensation that you have been at a place that you have more background. So figuring out what you can take on and how much work you can do to get your foot into the industry is a big piece of it as well. We have a guest on this season who I think is really interesting, where she had a job where she traveled a ton, was going through a very contentious divorce and felt that not pivoting was actually riskier for her than pivoting. If she stayed in the job with a lot of travel, she probably would have lost custody of her children. So she ended up becoming an entrepreneur, being place-based, creating a business that has now done incredibly successfully well. So it really is very circumstantial.
Well, it sounds great. I will be listening to this podcast very soon. Emily Tish Sussman, great to have you here. Host of She Pivots podcast, season 2, out today. Thanks so much. Well, coming up, after delivering its most watched season in over a decade, WNBA Commissioner Cathy Engelbert telling us about the league, how the league aims to maintain its momentum on and off the court in 2023. Stick around.
I mean, I've just pivoted so many times.
All right, let's do a quick check of the market, sponsored by Tasty Trade. Again, markets closing mixed. The Dow off 58 points. S&P turning positive in the final hour of trading, up just about 0.1%. The Nasdaq, the outperformer of the day, closing up just about 0.4%. Well, the attention and investment in women's sports is exploding. Just take a look at the WNBA, coming off its most watched season in 14 years, and the recent sale of minority stakes in the Seattle Storm, valuing the team at $151 million. That's a league record. Kathy Engelbert is commissioner of the WNBA, making her one of the most powerful women in sports. Kathy, it's great to have you back here at Yahoo Finance. Certainly, the WNBA has grown tremendously under your leadership over the last several years. Talk to us just about what this tells us about the upside potential of the WNBA and the investment opportunity that's out there for female sports.
Yeah, I think, Sean, it's great to be here. First of all, it says that we're a legitimate sports media and entertainment property. And I think for too long, women's sports weren't viewed that way, weren't valued that way. We have real revenue, we have real fans. So as you look at the world of investment, sure, women's sports, growth property on its way up. Looking at new media rights deals, looking at corporate partnerships. We know it's very underinvested area. These athletes are the best athletes in the world. And as the WNBA, when I came in, I said we were the longest tenured women's professional sports league in the country, double any other. So why don't we see more momentum? And we've seen that in the last few years.
We talk about the momentum picking up. I know you were just out with an announcement today with ESPN, the schedule here for this upcoming season. When you take a look at the ad spending, the dollars that are being allocated now to female sports, and specifically in this case with the WNBA, how does that ad landscape look, and how much growth have we seen within that?
Yeah, it's an interesting area, Sean. If you think about, at least the data shows that 80% of every consumer purchasing decision is made or influenced by a woman, right, in American households. And then you look at almost 50% of the athletes in the U.S. are women or girls, and we need more girls to aspire to be WNBA players and stay in organized sports in their teen years, where they drop off at alarming rates. So all of that leads to building a fan base, a consumer base. Every corporate partner we meet with, we say, what are you trying to solve in your business? We want more women consumers. We want more diverse consumers, and we bring that in our fan base. So that's part of the narrative.
And when we talk about professional sports, specifically for women, obviously, a lot of talk about pay and the fact that the pay is so low, especially when you compare it to the men's league. When it comes to the WNBA, what kind of progress are we making in terms of salary? And now there's talk about a potential soft salary cap. Is that something that the WNBA is considering at this point?
Well, first, when I first took the job, 4 days in, I was like, in my first collective bargaining meeting. So we tripled the top players' pay. And look, it's an economic model we're trying to build in order to enable the players to get paid more. Last year, we upped the bonus pool by 50%, the playoff bonus pool by 50%. We put $1.5 million in players' pockets this year in player marketing agreements that we, the league, are paying for them to market the league in the offseason. So we're chipping away at it. We're not where we need to be, because if really the statistics are true that less than 5% of all media coverage of sports is women's sports and less than 1% of all sponsorship dollars are women's sports, we're changing that. The denominator's huge, though, so my background in math and finance and accounting, we've got to change that numerator to be a bigger number and build the whole pie for all of women's sports, not just the WNBA. So we're working on it, not where we need to be. It's about media rights valuation. It's around valuation of whether it's a patch on the uniform, an ad buy, as you described. We're seeing a lot of positive data on companies wanting to take their DE&I, their diversity, equity, and inclusion platforms, and put their money where their mouth is and put it in women's sports.
Kathy, what's your perspective on name, image, and likeness, NIL deals that college athletes are now reaching, how much that is able to really help these athletes grow their personal brand, how that better positions them if they do decide to continue their career and they are able to play with the WNBA? How much improvement has that helped? And I guess, how do you see that continuing here as we move forward?
Yeah, I know there's a lot of discussion around NIL at the college level. I think it's actually helping our female athletes be more well-known. They have something that I didn't have growing up when I played collegiate sports called the social media. They've got huge followings, whether it's on TikTok or Instagram or Twitter, huge followings. And if you look at the women athletes, they're getting national brands supporting them in nil, not local brands necessarily. So they carry those into becoming a professional athlete. That's good for everybody.
One of the popular topics in the offseason for the WNBA is charter flights. It's been something that has been discussed time and time again. Teams can't use them on a regular basis. Where do those discussions stand, and how do you evaluate that when you're trying to get equal pay and equal treatment of these players?
Right, so we're constantly working on an economic model, but it lies in getting a great media rights fee, getting that right size. That valuation is very undervalued. That's what funds it in the men's leagues, by the way, are big media rights and big corporate partnerships. So we're chipping away at it. Last year we did it for part of our season. This year we're looking to chip away at it. But you want to make sure, Shauna, and you understand the business side of this, that you have an economic model to fund it in the long term. Yeah, we could do it for 1 year here or there, but you need to do it for a decade or more, if not essentially in perpetuity, because once you do it, you're stuck with it. And we don't want to jeopardize the viability, financial viability of this league. We've got enormous momentum. We're a growth property. When we're ready, when we get that great media rights fee package, and now you know the whole media landscape's being transformed with streaming, et cetera, that's when we'll be in a position to really do something substantial.
So it's on the table, just not necessarily for the 2023 season.
Right. Again, we're constantly talking with different companies, but it's about a funding mechanism so you can feel confident for the long term that you can afford it. And again, we're chipping away. We did it during our WNBA finals, our Commissioner's Cup, and we'll chip away at it over time as we build that economic model.
Well, Kathy, it's International Women's Day today, and we want to talk to all leaders like you, female leaders that have been extremely successful in their fields. You were at Deloitte for more than 30 years, the first female CEO of a Big Four firm, and now you're the commissioner of the WNBA. Your advice out there to a woman, to a younger girl who's looking to climb that corporate ladder, what would it be?
Yeah, number one thing is nobody's thinking about your career as much as you are. So you need to raise your hand to build your capability, whether it's running a business, whether it's stepping up to do something around risk management. And you think of all the things that are feeders into major leadership roles in the C-suite. Raise your hand, be confident. Women tend to, think, oh, I only have 7 of the 10 things I need to do this job. Nope, raise your hand because, nobody else has 7 out of 10 or 10 out of 10. So raise your hand, do different things, and you'll build your capability, and people will then start noticing that you can step up and be a leader.
And building that confidence, I think that's something that so many women struggle with, especially when they walk into that first meeting as a CEO, when that room is dominated by men. What did you do, and how did you build your own confidence to really conquer that situation?
Well, honestly, I think being one of 8 kids with 5 brothers, going to a school at the time in the 80s that was 4 male to 1 female, big engineering school, I think it was just something that was inbred in me. My mom used to say, you know what, you're going to do fine in a male-dominated world because you're growing up with 5 of them, and that was the 5 brothers. So, but look, it is about confidence. But what I always was curious too, curious to build my capability, do different roles, and it worked out because it gave me the confidence to sit in those rooms and not be treated differently, quite frankly. And that's why we have to have a voice for women. We have to have role models for the next generation of women leaders because they're there. It's just they need the confidence to build that.
And just be fearless, especially in certain situations. Are there any female leaders that you looked up to that were a role model for you when you were advancing in your career?
Yeah, I wouldn't pick one in particular. I sought out a variety of advice when I first became the CEO of Deloitte. All of a sudden, you're thrust into this big leadership role and got some great advice from different CEOs, whether it was a Meg Whitman or others that said, you have to do some small things of symbolic value to build trust. And then you'll get the harder stuff done, like culture change. And many companies that we all take over today need culture change. And so those are the types of things. I always looked for pearls of wisdom from other leaders, whether it was a man or a male or a female, looked for those pearls of wisdom and then kind of processed that into what I wanted to get done and the type of transformation I wanted to affect. Same thing at the WNBA. I didn't know a ton about sports other than playing it.
You were a basketball player and a lacrosse player in college.
In college. But playing it and running a league and running the longest tenured league in America are 2 different things. And then hitting COVID and a pandemic, and then obviously everything else we dealt with over the past couple of years. But that's why your training is setting you up. Whether you're training as an athlete and the resilience and how to lose, how to win, what to learn from your failures is so important. I think ultimately in building your leadership skills long term.
Great advice right there. Kathy Engelbert, great to have you. Thanks so much, Commissioner of the WNBA. Well, coming up, Kendra Scott taking us through the launch of her new foundation and how big of a role philanthropy is playing at her business. Stay tuned. It's International Women's Day, and we're honoring the achievements of women in business. Our next guest is an icon in the fashion world. She started by selling her jewelry designs out of her spare bedroom and built that business into a billion-dollar brand. Not only is she known for creating unique and bold jewelry designs, she's also devoted much of her time to supporting women's and children's causes. Kendra Scott, founder and executive chairwoman of Kendra Scott, is here with us now. Kendra, great to have you.
Thanks so much for having me. Thrilled to be here today.
So we have a lot to get into with you, but let's start with what you're announcing today, the launch of the Kendra Scott Foundation. What can you tell us about this foundation and its mission to change the lives of women and children across the world?
You know, since I've started this business, philanthropy has really been at the center of my business. Jewelry has actually been secondary to us wanting to really make a difference in the lives of women and children. And so since 2010, we've actually donated over $50 million to women's and children's charities across the country. And after 20 years in business, this was the perfect time to really say, hey, let's start a real, true foundation that we can use all these things that we've been doing and just have a central place where we can really make that giving even more effective and powerful than we have in the past. And here we are now having the Kendra Scott Foundation and launching it on this remarkable day.
So Kendra, women supporting women, obviously a huge importance to you, something that you are a true believer in. I know you've built your business from the ground up. How does this mentality apply to your business model today?
You know, I think for me, starting literally out of the extra bedroom of my house 20 years ago, and to be able to build a business and see how the power of empowering other women really makes such a difference. We are 96% female at Kendra Scott with, over 2,500 employees across the country. And for me, it was really important that we continue to empower women, the next generation of women, that they can also lead and build businesses just like mine. I founded the Kendra Scott Women's Entrepreneurial and Leadership Institute at the University of Texas just a few years ago. And that program is designed to teach the entrepreneurial mindset to women in any background. So any major, any school that you're in, you can learn the entrepreneurial mindset at the University of Texas through my program. So it's really just that foundation of continuing to empower women for the future.
Kendra, let's talk a little bit more about your success, because up till this point, you have over 100 stores and pop-up locations. You have a thriving e-commerce and also a wholesale business. What can you tell us just about the trends of the consumer, what you are seeing spending wise when we have so much uncertainty out there and this fear that consumers are going to continue to pull back their spending?
Yeah, I think what we've really been so excited to see that brick and mortar is not dead, as many were worried about during the pandemic. At Kendra Scott, we had to also close our stores during the pandemic. And we were worried, will shoppers going to want to come back out? And what we realized is community is so important. And that has always been the focus of our stores, is bringing community into our stores through our Kendra Gives Back events and other things. So we really had the most successful year. 2022 is our most successful year at Kendra Scott. And I think a lot of it was because people are so happy to be back together again, having that community spirit within our stores, and then also really meeting her wherever she might be. And if that's digital at home, we've really kind of ramped up our e-commerce and ability to give her a really easy shopping experience. So, the key for us is meeting the customer where she is, wherever that might be in that day. And it really is kind of that trifecta of retail stores, e-commerce, and wholesale, and how we really bridge those all together to give the customer the absolutely best experience.
And Kendra, you've also had a heck of a lot of success on social media. I know you capitalized on the popularity of the Bama Rush videos on TikTok. I got sucked in. I heard your name numerous times on those videos. You have certainly developed a very devoted fan base. How much of that do you attribute to social media? And walk us through just why you think you've been so successful on those platforms.
It's been so funny because obviously I am a mom, I don't know if you know this, to 6, a bonus mom and mom to 6 children. And so they've introduced me to TikTok. So they were actually the ones that first saw this trend happening and saying, Mom, you are all over TikTok. And I'm like, what are you guys talking about? And then of course got the call from our media team as well. But I think what makes us different is that we are such an authentic brand, an authentic connection to our customer. We have, brand ambassadors. We have a GEMS program that is in universities across the country. And these GEMS are out there meeting with the sororities and different leaders within the universities and making a human connection, not just about the product, but they're really getting to see, who we are as a brand. We're inviting students to get involved in some of our philanthropic outreach events. And that connection, I think, has made us so different. And one of the things that excites our fans to show that wherever they want to. And it just so happens that social media, TikTok, and some of those others were ways for them to express their love of Kendra Scott. And let me tell you, I sure loved it as well.
I definitely loved it. I know those videos, they're so entertaining. It's so addicting. It's hard to get off TikTok once you get sucked in. Kendra, you also have a strong presence here among celebrities. Jessica Alba, Kate Hudson, just to name two, that have certainly sported your jewelry on multiple occasions. When you partner up with a celebrity or decide that a celebrity wants to represent your brand, how do you decide that, and what has that done for the growth in your business?
So what's so funny about a lot of these times is we don't even know that it's happening. These are a lot of, in times, authentic connections, again, that the celebrity may have made with our brand, loving the things that we represent, wanting to be engaged and involved, because our jewelry brand really is more than just beautiful designs, which obviously it is, but it also has that component of giving back to women and children. And I think you see the celebrities that have worn our jewelry consistently share my core values. We share the same heart. We care about the same things. And it's almost always the case. When I see a celebrity, I'm like, yep, that's a giver. She's got a giving and loving heart. And I think that's, where you see us pairing with the best celebrities is it's an authentic connection.
Well, Kendra, a lot of people turn to you, I'm sure, for entrepreneurial advice, what they should do when they're looking to grow their business. You have been a recurring shark on Shark Tank. First, just what is that like, being in that seat, trying to decide which business of many to invest in?
It is an absolute blast. Let me just tell you, I have so much fun being in the tank. I love my other sharks, but what I've really loved is being able to see all these fantastic founders, and so many of them female founders, coming in with such passion and drive and excitement. And when I first was on season 13, when I was on that season, it was so crazy because we were in COVID and we were thinking, is the entrepreneurial spirit still alive? Is it still going to be out there? And when these amazing entrepreneurs entered the tank, gave us their pitches, I think all of the sharks, we looked around with huge smiles and saying, the entrepreneurial spirit is not dead. If anything, it is more alive than ever. And I think for all of us, we love that. We feed off of it in a good way. And it's just been something I love being a part of. It's really phenomenal.
And Kendra, some of the teams, or some of the businesses, I should say, that you have teamed up with, Booty Bag to name one, Sienna Sauce, Opulence MD. What's the common thread among those entrepreneurs or among those businesses, or that one trait that you look for?
A passionate founder. I think if somebody is just doing something to make money, if that's their only goal, they're never going to be successful. Entrepreneurship is so difficult. There are so many peaks, but there are so many valleys. And if you don't have that passion, that drive, that love for what you're doing, you're never going to be able to survive those valleys. And so I look for those passionate founders who are really finding white space in a market. And I know that they'll be able to get through anything that heads their way because of that drive and passion inside of them.
Certainly is inspirational. Kendra Scott, great to have you, founder and executive chairwoman of Kendra Scott. Thanks so much.
Thanks for having me.
Being born to rich parents is the #1 strategy to being rich yourself. But if you don't have rich parents, don't stress. I'm Vivian, your rich BFF. I'm a former Wall Street trader, and I can teach you how to be rich. That's why you follow me.
That was Vivian Tu, the financial literacy creator who goes by Your Rich BFF on TikTok, and she's here with us today. She has 2.8 million followers on TikTok. Nice to see you, Vivian. So a lot of talk about banning TikTok, in particular in the federal government. What would that mean to TikTok creators like yourself?
I think it would definitely be a big hinder to a lot of creators because TikTok is definitely one of the easiest places for discoverability. It's the reason why so many young people are on it now, hoping to become creators. People know that TikTok is where you go viral.
Vivian, the engagement that you certainly do have on TikTok, over 2 million followers there, your ability to resonate with those out there, those that are looking to build their wealth. What do you think that connection is and why it's so successful on TikTok specifically?
I think the content that I create is very quick, very punchy. And as young people's attention spans get shorter and shorter and shorter, TikTok and short form video more broadly is just the perfect medium to teach quick little bite-sized lessons every single day. People are no longer picking up an entire book, reading it front to cover, or even watching a 15-minute YouTube video. They want to learn something in 60 seconds. And I think that's why people are willing to sit through that time with me.
Yeah, Vivian, it's really nice to see your success because there is this notion that everyone's just watching silly dances on TikTok when in fact they are learning an awful lot. I can vouch for my own kids having learned a lot from TikTok. So if it's banned, where would you go? Is there a similar platform that would allow you this opportunity?
Yeah, I think as these concerns of this bipartisan bill to ban TikTok are, growing and people are whispering about it, there's a lot more concern from creators to become irreplaceable. They're trying to have platforms both on TikTok, but also on meta platforms such as Facebook and Instagram Reels, YouTube Shorts, Snapchat's Spotlight, Pinterest Idea Pins. Every single platform right now has short form video content. And even more so than that, a lot of creators are trying to have owned and operated platforms, whether those be blogs or websites, so that they can reach their audiences directly.
So Vivian, your tips on how to build your wealth, that's what everyone's following you for. That's what everyone wants to know. And you discuss videos from taxes all the way to saving money on your wedding flowers. So what's the one or two things people can do to save their money?
Yeah, I would say the first and easiest change to make is to transition from a traditional savings account to a high yield savings account. They sound very similar because they are almost identical, except with a high yield savings account, you're making significantly more in interest every single year. So while your money is just sitting there waiting to be used on things like bills or waiting for a down payment on your house, you are able to make more interest. Next up, I think a big lesson that my mentor taught me is that you can only save as much money as you earn. So it's really, really important that, especially in a high inflationary environment, we are asking for raises at our jobs every single year.
Financial literacy, there is a massive void out there in terms of how young people are coming up through, whether it's high school or college. Is there a particular area of focus that you find really lacking the most in terms of knowledge that people need to have when it comes to finance?
I think it's just a basic understanding of the jargon. I think people are a lot more intelligent than we give them credit for. And the reason that they are so nervous about investing or financial literacy is because there's so many words that they don't know. That said, I think if we can do a better job in the public school system, educating people about how debt works, how student loans work, what the process is to buy a home, what the process is to buy a car, and how to negotiate for a higher salary, our entire society would be better off.
I could not agree with you more. I was disheartened that I had to explain the concept of inflation to 17-year-olds the other day, albeit very bright ones. On this International Women's Day, I'm curious, do you have any tips for the masses out there that would love to follow in your footsteps and become a TikTok or a social media influencer? What's your best advice, your tips?
don't wait for perfection. Do not get paralysis by analysis, trying to find the perfect niche or the perfect content. Just start posting. Right now, the algorithm changes every single day, every single week, every single month. So you never really know what's going to hit. There's content that I spend hours on that I'm like, oh, 4 people saw this. And then there's content that I spend 10 seconds on and it gets millions of views. So truly just start creating and don't be afraid what others are going to think about the content you're creating.
That is the fear, Vivian, that you're going to get 3 or 4 likes and then it's going to set you back. Excellent advice. Vivian, 2.8 million followers, your rich BFF on TikTok. Great to have you. We appreciate it. All right, Shauna, let's take a look at what's trending after hours. What do we got?
All right, Dave, we got 2 names for you here, Silvergate and American Express. Kicking off with Silvergate, you're looking at losses of nearly 27%. The company announcing plans to wind down operations, also liquidate the bank. Now, in a statement, the company is saying that, quote, this is the best path forward here for the bank, and that they do plan to wind down, and liquidation plan here includes the full repayment of all deposits. So taking a look at an extended chart here, extended hours off just about 27%, year to date off about 71%. If you're not familiar, Silvergate Capital is that crypto-focused bank, has been in hot water ever since FTX absolutely imploded here. Just taking a look at that 1-year chart. So here we are today, closed today just below $5 a share before this after-hour sell-off, a far cry from where we were just about a year ago, right around $160 a share. And in the aftermath of this, Signature Bank, another crypto-focused bank here, off just about 3.5% in extended trading. Also pulling up American Express on the flip side, that's moving higher, up just around 1.5%. The company authorizing a new buyback plan, also raising its dividend 15%. We're seeing some excitement about that in the after hours. Year to date, stock off to a strong start to the year. We're looking at gains of just over 18%. Well, still ahead, we will visit some of the biggest stories of the day. But first, if you're still planning to book your flights for spring break, you got to get on it because your wallet could take a beating. We've got the details for you when we come back.
Consumers sure have shifted their spending from goods to services, and you've no doubt heard that a time or two in recent months. But no one industry exemplifies that shift better than America's airlines. And if you haven't booked your spring break flights, you'll want to listen up, or you might want to put on the earmuffs. I'm not entirely sure. If your plans include a visit to the House of Mouse, rent a car, or simply just don't do it. the prices have just gotten goofy right now. Round trip tickets from anywhere in the U.S. between March and April were 31% higher than 2019, as Orlando ranked as the top destination for U.S. travelers during those months. And while the Lone Star State will host both the men's and women's Final Four, March Madness best describes the price you'll pay to fly to Vegas and watch and bet on the big dance. Airfares up 41% from pre-pandemic. Want to head south of the border? Say adios to a grande chunk of change. Cancun will cost you 51% more than 2019. These numbers from Airlines Reporting Corp. A staycation probably is sounding good about right now, but if you insist on being one of the 158 million Americans to fly in March and April, check out some drivable destinations, often overlooked gems within reach of a tank of gas, or you can zag, opt for those less traveled destinations. Hopper.com gave us a few. Here are a few tips on flights on the cheap to Miami as opposed to Orlando, $242 round trip. How about some spring skiing in Colorado, a round trip from $230, or holiday, as they say across the pond. Might sound like a lot, but London for $689, pretty solid bargain. I think the looming question here with this ridiculous demand travel is this, Shauna, is it pent-up pandemic demand or revenge travel, as they call it? Or is this a permanent shift in our priorities? I think it's the latter. Yeah. When I was just on vacation, I asked a lot of people in terms of just general questions about how they're able to afford their vacations, and they didn't really know. They didn't really care. They just wanted to get out and spend, even if it meant sacrificing some things at home. I think that is a permanent pandemic shift. What do you think?
I think it is a permanent pandemic shift. I hope, though, that these prices are not permanent. I hope we are going to see some easing in the pricing pressures, especially on those most popular routes, because when you look at that dramatic increase, I mean, I'm not going to Las Vegas anytime soon, but if I was, I wouldn't be happy if I was looking at a 40% increase in airline prices. But I do think it is a permanent shift. I do think people are now thinking a little bit harder about how they're spending their time, spending it more wisely, and really being more intentional. And I think that's why the demand hasn't pulled back at all, and especially in this environment when people are already spending more in almost every aspect of their life. They're still allocating a portion of their budget to travel, and that's good news for a lot of the airlines, a lot of the cruise lines that are still waiting for that boost, potentially, if people do eventually return to the cruise lines. But I do agree with you. I think it is a permanent shift. I hope it is a permanent shift. It's a good time. It's a good way to spend your time.
Those prices, bad news for Jerome Powell and the Fed as they try to get inflation under control and just can't get people to stop traveling. Las Vegas, you mentioned it. Their convention bureau has never seen flight levels like they're seeing right now. People are going to Vegas like never before. And it's not just to gamble, it's to see shows, it's to watch and bet on the NCAA tournament. And then we've got a Super Bowl there coming this year. We'll see if this trend stops. I would bet in Vegas that it will not.
I'm surprised, but you found a round trip for 600 something bucks for London?
$689.
I just paid close to that price for a destination that isn't nearly as exciting.
I would imagine.
It's a little close to home. All right, well, it is closing time here at Yahoo Finance. Let's get you caught up with everything that happened today. Fed Chair Jerome Powell spending a second day on Capitol Hill, this time addressing the House Financial Services Committee. Powell stressing that more interest rate hikes are likely necessary. He also made it a point and very clear that upcoming data will be what determines the size of that next hike. One piece of data that he will be watching very closely, Friday's jobs number.
No doubt. Tesla shares closing 3% lower. A couple of things hitting the stock today. First, analysts at Behringer slashing their rating on the stock to hold from buy, citing the stock's valuation and lack of a cheaper Tesla model. Also hurting shares. U.S. safety regulators say they're investigating reports of steering wheels detaching in 2023 Tesla Model Ys. The National Highway Traffic Safety Administration says around 120,000 vehicles could be affected by the problem.
Looking ahead to tomorrow, the CEO of Norfolk Southern will be testifying before the Senate Environment and Public Works Committee about its recent train derailment in Ohio. Now, officials have been ramping up scrutiny on Norfolk Southern following that incident. Just yesterday, the National Transportation Safety Board announcing that it was launching a special investigation into the company's organization and safety culture. All right, well, that does it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here again tomorrow. Have a good night.